Good morning, everybody. Welcome to Strategies for Retirement Transitions with our founder, Chuck Vickery. Thank you so much for joining us today as Chuck discusses some strategies for retirement transitions. How do you best chart a path to retirement income streams? And most importantly, how do you lose the least amount of wealth to taxes over not just your retirement, but multiple generations? We have both a chat box and a question and answer box here. So as Chuck goes through his presentation, if you feel like you've got some questions for Chuck, we'll go ahead and answer all of those at the very end. So just feel free to pop those in at any time. Most of you know Chuck already, but if you don't, Chuck is not only a wealth advisor here at Elevate, but he founded our original company back in 1982 as Vickery Financial Services. Chuck specializes in comprehensive wealth management planning for retirees and pre-retirees. He graduated from UGA with a Bachelor's of Business Administration and Risk Management. He's been active in the Athens financial community since his 1972 discharge from the U.S. Army. Chuck and his wife, Patsy, are members of First United Methodist Church. Chuck's a past president of the Georgia Tip-Off Club, the Northeast Georgia chapter of the Society of Financial Service Professionals, and the Classic City Rotary Club. Chuck currently serves as a trustee for the Georgia Rotary Student Program. Chuck, thanks so much for joining us today and talking about strategies for retirement transitions, or as you like to call it, spend down.
I do, Betsy. Thank you. Thank you, and welcome, everyone. We're glad you're here. So let's see if I can figure out how to share my screen. All right, so thank you for coming. As you know, Vickery Financial is now Elevate Wealth Advisory. I retired about 4 years ago, and I'm just working with a few clients now. And originally, when I started working on this, it was to give me something to do, and we called it Spend Down, but we changed it to Strategies for Retirement Transitions. And the goal for most people is to obtain or maintain, if they're already there, financial independence. And the purpose of our discussion today is to show you ways to do that. Now, when you design, build, and protect a plan, it requires an integrated approach across many of life's areas as well as financial areas, and there are key moments in each. And today, what I want to do is take you from age 20 all the way to age 90. And I want to start by just reminding you of things that we can and cannot control. We have absolutely no control over the stock market. I wish we did, or the bond market, or the real estate market, or the federal government, or foreign governments, or Mother Nature with her fires and hurricanes and tornadoes and earthquakes and tsunamis. These are all things that sort of get us upset sometimes, but we don't have any control of that. But we do have control over how much risk we take with our investments. We have control over having a diversified portfolio rather than a concentrated portfolio. We have control over how much we pay for our investments, and we have control over our taxes. And that's one of the things we're going to talk a lot about today, because people say, I don't have any control. We're going to show you how you do. And we have control over our behavior. And as far as investment returns go, behavior is probably the single largest factor in determining your personal rate of return. And people that stick with plans through thick and thin do much better than folks who are constantly making changes. And we know that patience wins, and patience is rewarded, because money is like soap. The more you touch it, the less of it you have. At Elevate Wealth, we believe you deserve to be equipped with the tools and resources to confidently live your best life. And we combine our knowledge and experience to help grow and align your wealth so you can realize those things that you envision. And that's what we're going to do today. We're going to show you how to take advantage of those things that you do control. And we're going to show you what those tools are, which in addition to software programs and making smart financial decisions, it's having just a good understanding of your overall wealth experience and what lies down the road. So let's get started. And we designed a 5-page brochure that we call Strategies for Retirement Transitions. And if you'd like a copy of this, at the end, we're going to show you how to request this. We start with accumulation, and that's the first phase. And accumulation starts with your very first paycheck, and it ends with your very last paycheck. And what we have found is that most people are stuck in accumulation. They don't even know these other phases exist. If you pick up a newspaper, a magazine, a book on investing, it's all about accumulation. And there are a lot of people that are really, really good at accumulating money. And they find that when you retire and you go into these other phases, it takes an entirely different skill set. So we're going to talk about some of those skills that are necessary today. Decisions that you make in accumulation impact you throughout your life. So decisions you make at 30 impact you at 80. The next phase is transition. And transition starts when you receive that last paycheck, and it lasts until age 72. And in this phase, it's a very short phase, but in this phase, our objective is to preserve your wealth while paying taxes and to make some proactive decisions while you have some flexibility. The next phase is distribution, and it starts at age 72 and it lasts until death. And now you're fully retired. You're funding your lifestyle from Social Security and the assets that you've accumulated. A lot of people tell us they just want to live off their interest and dividends when they hit this phase. And you've always heard defer, defer, defer your entire life. However, at age 72, the federal government forces you to start taking this money out and spending it and paying taxes. And that's why we originally called this program Spend Down. And then the final phase is legacy. And this is where you plan for your heirs and charitable causes. Here we want to make sure the right person gets the right asset at the right time. And while investment consulting is important, and we spend an awful lot of time in this office talking about investment consulting, that's not the only thing that we talk about. You'll notice it says life and health, investment, tax, estate, and risk. Well, basically, we want to talk about family planning. We want to talk about maintaining good health for a longer, healthier lifestyle. We want to talk about wealth enhancement, which is lowering your taxes. We want to talk about estate planning, again, making sure that your assets pass to the right person. We want to talk about risk management and wealth protection so that assets are not unjustly taken from you. But we also want to talk about charitable giving. We want to talk about smart ways to take Social Security, and the best way to take Social Security. We want to talk about Medicare and how that works. So a lot of different things go into the overall planning process. And there are only 4 things you can do with your money. You can spend it, you can give it to your heirs, you can give it to charity, or you can give it to the government. That's it. So what we want to do is sort of go through these things and see, when should we spend it? When should we give it? When should we give it to charity? So when we go through the planning process, we do it a little different. We do it backwards. It's sort of like a jigsaw puzzle. When you're getting ready to do a jigsaw puzzle, what's the first thing you do? You get all the pieces and spread them out. Maybe you get all the edges in a line to see how they fit. Maybe you get colors together, but sooner or later you go back and you look at the box. What are we trying to accomplish? At the conclusion, where are we going to be? Well, when we plan, we sort of do it that way. We look at the end result. Where do we want to be and what's it going to look like? So rather than starting with accumulation, we're going to go backwards. And we're going to look at legacy. And I failed to mention you see these little starburst on here, or stars. Those are collaborative moments. That's where we need to bring in a professional that's not in our office. It could be a CPA, it could be an attorney, it could be a mortgage broker, it could be whatever. But there are times that we do need to bring other specialists in. And we have points of interest in each one of these transitions. So what I want to do is go through those points of interest with you and sort of let you know what we think you should be doing. And first one is pretty obvious. Leave assets to your surviving spouse. Equalize ownership of equities while both spouses are alive. Accumulate unrealized gains for tax-free step-up in basis at first death, and transfer assets in a tax-efficient manner. Well, these are different, but they're linked together. It's rare when the federal government gives you anything for free. But when they do, raise your hand. Take advantage of it, okay? So under current tax law, we have what's called a free step-up in basis. And a step-up in basis basically means at your death, the assets that you own, the value is what they can be sold for with no taxes being paid on them. So for example, your home. You might have been in your home for 20 years. It's appreciated in value. You haven't had to pay taxes on that appreciation because you haven't sold it. At your death, your heirs can sell your home or any other asset that you own that's a personal asset and not have to pay any taxes on it. So when we say leave assets to surviving spouse and equalize ownership of equities while both spouses are alive, what we're saying is we don't know who's going to die first. So put some money in your name, put some money in your spouse's name. At the first death, the survivor inherits that. It takes a step up in basis, and that money is no longer taxed until it grows again. So it's a way for the survivor to have a lot of tax-free income if it's needed. And to get this step up in basis, you have to have unrealized gains. And that's where you have real estate, stocks, some asset that has appreciated and you haven't had to pay tax on that appreciation. And at death, it steps up and nobody pays any tax on that appreciation at the first death. So that's important to us. And we want to transfer assets in a tax efficient manner. So to do that, you've got to have the right type of assets. There are certain assets that do not step up, and we're going to talk about those. So this is what we call the tax buckets. So money is either got to be in a retirement account or in a regular account or in a Roth account. That's the only type of accounts that are out there. And if you'll look at the bottom under the tax deferred bucket, that's where all your retirement accounts and annuities and pensions are. And that's fully taxable to your heirs. Somebody's going to pay tax on that. You're going to pay the tax when you take money out at your death. Your heirs are going to pay taxes on it. The tax advantage or taxable account is in the middle. And if you'll look at the bottom, step up in cost basis at death equal tax-free to heirs. So we like tax-free. And then the Roth accounts, whether it's an IRA or 401k or 403b, those also transfer to our heirs tax-free. So we want to fund our surviving spouse's lifestyle with inherited assets. And we do that by equalizing ownership, unless you know who's going to die first. Now, if you know who's going to die first, put everything in that person's name. And you get a step up in basis at the first death that the surviving spouse can live off of. But we want to get a double step up. So when the surviving spouse dies, the remaining children and heirs and grandchildren get a second step up in basis, and they don't have to pay tax on it. So basically, anything that goes through your will gets a step up in basis, along with things that are jointly owned that do not offer deferral, like bank CDs, brokerage accounts, things of that nature. Now, there is an exception to step up, and it's called income in respect of the decedent. And that's a funny name, but the government uses that to refer to accounts that give you deferrals, like annuities. You can accumulate money in annuity and you don't pay taxes on it until you take it out. It defers the tax. Retirement plans defer the tax. Government savings bonds defer the tax until you sell them. Well, the problem with deferral is when deferrals end, taxes begin. So these things do not step up in basis. So your home steps up, your stock step up, your real estate steps up. If you've got old cars, they step up, whatever. But if it's in one of these things, annuities, retirement plans, or government savings bonds, those do not step up. But there are two ways you can take money from deferred accounts and either eliminate or at least lower substantially the amount of taxes on. And we see a lot of people are charitably inclined, and their wealth protection documents in their wills, they name their church or they name their favorite charity as a beneficiary, and they want to leave money to them. What we think you should do is, rather than naming a charity in your will, is make the charity a beneficiary or one of the beneficiaries of your IRA. So we recently ran into somebody and they had $1 million IRA and they had $1 million in assets in their will because their children were doing very well and didn't need the money, they said. They left the IRA to the children and they left all their personal assets to the charity. Well, the problem with that is that the children are now going to have to pay taxes on that IRA because that's deferred income. And the charity doesn't have to pay taxes at all. So big deal. They get money and they're happy for it and they really appreciate it. But what if we flip-flop that? What if we give the children the money that steps up in basis and take the charity out of the will and then name the charity as a beneficiary on their IRAs? And this has come up several times lately. It's much better to give the charities from your IRA than from your will. Think about it. Would you prefer to inherit something that's fully taxable or something that's tax-free? The other way we get money out of deferred accounts, these annuities or retirement plans or bonds, is holding deferred structures to fund end-of-life costs. So here, what we want to do is match up large medical expenses with your IRA. So if you don't have long-term care insurance and you have to go into a nursing home, and let's just say it's $100,000 a year, and you take $100,000 out of your IRA, you have to include that as income. But you also get to write that off because it's a medical expense. So that's a way to get money out with very, very low taxes on it. In December 19th of 2020, Congress passed the Secure Act, and excuse me, 2019. So we're starting 2020 gearing up to talk to everybody about the Secure Act and how it impacts them. Well, something else came along called COVID and everything shut down. So the Secure Act sort of got pushed aside, but it does two things. It does a lot of things, but there's two things that impact most of our clients. And one of them is you don't have to start taking money out of your retirement plans until age 72. It used to be 70 and a half. The other thing that it did for non-spouse beneficiaries, or for children that are beneficiary of IRAs, they have to take the money out of the inherited IRA in 10 years. Prior to 2019, if a child inherited an IRA, they could take it out, what we call a stretch IRA, over their lifetime. Now they've got 10 years to take that money out. They take it all out the first year or the 10th year or a little bit every year, but they've got to have that account liquidated at the end of 10 years, or there's a 50% penalty. So this Secure Act is playing havoc with estate planning. So one of the things that we're suggesting to people is if you have successful children, the last thing they really want is to inherit something that is fully taxable. And they really don't want to have to deal with it over 10 years. So if you have the resources and it's possible for your surviving spouse to live their life and stay in their world and be comfortable, maybe you should make your children one of the beneficiaries of your IRA so that at the first death, they inherit some of the IRA. And then at the second death, they inherit the IRA. And it gives us 2 10-year periods for the children to use for planning and save them a substantial amount of taxes. So we want to transfer assets in a tax efficient manner. We want to die with the right asset. We want to die with things that are not retirement accounts, so they do step up. When we get late in life, we want to take a look at our family situation. If we're in a lower tax bracket than our children are in, maybe we should accelerate taking money out of our retirement plans and maybe take out more than we need. We don't have to spend it. It can be repositioned so that it steps up and it can be tax efficiently invested so it doesn't create taxes. But it's something that will lower future required minimum distributions and lower what your heirs pay on the taxes. And then the other thing is family circumstances. So we've got a client that had $600,000 in their retirement account and a home worth about $400,000. One child was a doctor and one child was a school teacher. And they wanted to leave everything 50-50. Well, in looking at it, and when we crunch the numbers, they're better off leaving the $600,000 that's taxable to the school teacher, because the school teacher's in a lower tax bracket than a doctor, and leaving the doctor the family home that's worth $400,000. So at first you say, well, they love the school teacher more because the school teacher got 60% of the money and the doctor only got 40%. Well, yes, that's true. But when you take it through the tax ringer, they both ended up with more money than they would have gotten had it been split right down the middle, and each got half and half. So we want to align your plan with your personal values. We not only want to pass assets to our heirs, but we want to pass our values on to them. And family meetings and conversations with children is critical to having a successful legacy. And everything just works better after your death if there has been communication during your lifetime. So we want to do that. And legacy planning is important, but everything relates back to the lifestyle that you want. We don't want the tail wagging the dog. We're not living on our money so our kids can get it. We want to live the life that we want. And if there's any left over, we want the kids to have it. But build a plan for your family to lose the least amount of wealth over multiple generations. So prior to legacy, we have distribution. And now this is income from all sources, including investments, Social Security, whatever, pensions. So what we're looking at here are bullet points to do smart rebalancing and distribution and philanthropic impact while preparing for our legacies. So when we look at these bullet points, we find that when you're in distribution, you lose flexibility as Social Security and required minimum distributions are mandatory. So your Social Security goes up every year until 70, and then it plateaus. So there's no reason to wait past 70. And at age 72, you're forced to start taking money out of your retirement accounts. So you just don't have a choice. As I said earlier, deferrals in, taxes begin. We have a forced spend down of assets. So what we want to do is analyze your financial capacity for your assets to take care of you and mama and see where we are. And to do that, we focus on after-tax, risk-adjusted market returns. And the reason we do that is because this gives us those unrealized gains that aren't always taxed. We think that you should know your required minimum amount. And that's for a couple of different reasons, because a lot of times people don't realize what theirs are going to be. And as you get older, the amount you have to take out goes up. So, hey, everybody likes raises, but Social Security has a cost of living on it, and required minimum distributions increase every year. And if you are not taking your required minimum distribution in a monthly check, make sure you take it early. If you don't need it, don't wait till the end of the year when you've lived off all your other assets and then have it come in and bump your income up. Take it early and don't spend as many other assets. So we have what we call financial goal plan, and we can use this to analyze your situation, where we can define the cost of retirement. First of all, we want to know what your goals are, and we'll help you with those. Then let's define the cost of retirement. Let's do an analysis of your capacity, because what we want to do here is create absolute clarity as to what your money's doing for you and what it will do for you. And then we're going to focus on those after-tax risk-adjusted market returns. And what this basically shows us is it gives us a percentage of you being successful. And anything above 70 is considered good. We want to determine a Social Security strategy. Now, we don't do that at age 70. We do that earlier. If you wait till 70, that's how you maximize the amount of money that Social Security pays you. But that's not the proper strategy for everybody. Sometimes it's much better and much just makes sense to take it earlier. And the numbers tell us to take it earlier. But all things being equal, if you wait till 70, you'll get the maximum amount out of Social Security. So how do we reduce taxes when in distribution? Because you've got to take Social Security, you've got to take your RMD, you've got your dividends, your capital gains, you've got other income coming in. Well, if we can manage that income to reduce taxes, that's great. We want to keep your adjusted gross income, if possible, just under $112,000. Now, there are some people that are living on a lot more than 112 and don't want to go down, and I understand that. But if you're living on 60 or 70 or $80,000 a year, let's try to bump that up to 112. And the reason for that is it keeps you in a low tax bracket and ultimately lowers your future required minimum distributions, and it lowers the taxes that your heirs pay. And if you keep your income at 112,000 or less in the distribution phase, any qualified dividends and long-term capital gains that you have are not taxed. Now, if that's not possible, let's shoot for an income under 182,000. And the magic of 182,000 is that's when Medicare decides you can pay more taxes. And nobody wants to volunteer to pay more taxes, and they don't want to volunteer to pay more for their Medicare. So, and one of the ways you can get your income down is by making charitable gifts the right way. You can donate your required distributions to charity. Now, the Secure Act says you don't have to take money out until 70 and a half, but they did not change one little thing that sort of surprised me. And that is that at 70 and a half, you can have your IRA send money to your charity, and you do not have to include that as income. And that's called a qualified charitable distribution. And we think that that is a great way for people that are 70 and a half to make charitable gifts. So I gave this talk to a group a few months back. And the question out of the audience was, look, our income is about $100,000. Our church is having a building program, and we want to pledge $20,000 and take that out of our IRA and be done with it because we want to help. What's wrong with that? Well, If you take 20,000 from your IRA and you put it in your checking account and you write a check to the charity, well, first of all, you've withdrawn an extra 20,000. The charity gets the 20,000 you wanted them to have. The 20,000 helps satisfy your required minimum distribution. And that $20,000 is reported as income to you, and you have to pay taxes on it. And the tax bill on at a 22% tax bracket, which you would be in, is $4,400. So the total cost of that charitable contribution is $24,400. Now, if we use the qualified charitable distribution, you tell your IRA, make a check directly to the charity. So the IRA sends you a check. It's not payable to you. It's payable to your charity. You deliver it to the charity, so they get the $20,000. The $20,000 still helps satisfy your required minimum distribution, but the $20,000 is excluded from taxable income. And the tax bill on the distribution is zero. And you just save $4,400 compared to doing it the previous way. Now, if there's a caveat to this. Let's say you took $50,000 out of your IRA and $20,000 went to charity. You have to tell your tax preparer. The custodian is going to send you a 1099 for $50,000. If you tell your tax preparer $20,000 of this went to charity, then on your tax return, they put amount received, $50,000, amount taxable, $30,000. The $20,000 is not included, but you have got to tell your tax preparer. So we want to fund the remaining lifestyle spending with the lowest tax cost investments. So if you've got Social Security, you don't really have any control over that other than when it starts. And if you've got your required minimum distributions, those are set in stone by the formula that the IRS has. But if you need additional monies to live on, one of the ways that we tell people is to identify, and this is a CPA term, non-portfolio 1099 income sources. What that means is you're getting dividends and capital gains on your investments. Rather than reinvesting those, take them in cash. You've got to pay tax on them whether you reinvest them or not. And there's no reason to reinvest them and then in 6 months, sell them so you can have the income and potentially pay ordinary income tax on that rather than getting preferential tax treatment. To the extent that you need more income, in up markets, sell stocks with a high basis. So if you've got one stock that's worth 100,000 and you paid 80 for it versus another stock or mutual fund that's worth 100,000 that you paid 20,000 for, sell the one with a high basis, the 80,000, and you only pay tax on 20% of what you pull out. And it's taxed again at preferential treatments. So, and that's in up markets. And down markets, sell some of your bonds. Don't sell them the stocks in down markets, sell bonds in down markets. And we want to transfer wealth to our heirs. When you give somebody a Christmas gift, they can do whatever they want to do with that. There's no tax on it. And when you transfer money to heirs, there's no tax on that at the time, unless it's a very large amount. And you can give up to $16,000 a year to anybody that you want to give it to. Now, people normally give that to children, grandchildren, daughters-in-law, son-in-law, things like that. But there's no tax on that if you give them cash. If you give them stocks, mutual funds, real estate, then the cost basis of the stocks, mutual funds, and real estate goes with the gift. So if you bought a lot for $10,000 15 years ago and it's now worth 50 and you give that to your son, when your son sells it, his cost basis is $10,000 and he's got to pay tax on the gain. But if you give him cash, there's no tax on that. And if you leave him that lot in your will at death as a bequest, it steps up in value and he doesn't have to pay any tax on it. So we want to create gifts to our heirs where we have the resources to do so. We want to share our legacy with them. We want to tell them what we want to do. They can do whatever they want with the money. You can make suggestions, but the main reason for giving money in retirement is so that you can enjoy your heirs using this money while you're alive. And I sometimes say it's better to give with a warm hand than a cold hand. So when you're in distribution, there's a lot of must. You must take Social Security. You must take your required minimum distribution. But there are things you can do to increase your odds of living the life that you want, not running out of money, and reduce your taxes. And that's what these bullet points are all for. So prior to distribution, we get into transition. And if you'll notice at the top, that little blue bar on the upper right-hand screen, transition is a very short period of time. That's from the time you get your last paycheck until you hit age 72. And there's a window of opportunity in there to design a strategy that minimizes tax liability over the long term, not just in current years. So when we look at this, it's a time to make proactive decisions. So we want to estimate your taxable income. What's it going to be? Now, remember, you just retired, and also retirement and taking Social Security are two entirely different decisions. One can be made independent of the other. So let's estimate your taxable income, and you do not have to take Social Security until 70. You do not have to pull money out of your retirement account until age 72. So maybe if we live off of our earnings, our savings, and our taxable accounts, taxes might be pretty low. So if we develop a tax rate bracket strategy, most people today do not itemize. The standard deduction for people is about $26,000. Those over 65, it's about $28,000. So Uncle Sam says the first $26,000 you earn, there's absolutely no tax on it. And the next, this is for a couple, the next $20,000 the couple earns is taxed at 10%. And the next $60,000 is taxed at 12%. So that's how we get this $109,000. Basically, that you don't have to pay tax on this money, or you don't have to pay a lot of tax, 10% and 12%. I'd volunteer to pay 10% tax on all my money, and I'm sure you would too. So if we can project future income, if you do nothing, what your RMDs are going to be when we add that on top of your Social Security and your dividends and capital gains and other things. Well, we have a plan we call Holistoplan, our program we call Holistoplan. And what it actually does is it takes your tax return and it does an analysis of it. And with your tax return and your investment statements, we can give you a crystal clear picture of what your taxes and what your future income is going to look like. So you might notice that there's ordinary income, and in this particular couple's income, taxable income, was $91,745 after the standard deduction. Well, they're in a 22% tax bracket. Now, in the middle of the screen, it says the marginal tax rate for your capital gains and qualified dividends income is, well, if your adjusted gross is below 112, you don't pay taxes on capital gains and qualified dividends. But these people were above that. So they're in a 15% tax bracket. So they had to pay 15% tax on their capital gains and their dividends. But I'd rather pay 15% tax than 22% tax. That's almost a 40% discount. And you'll notice the maximum tax rate for ordinary income is 37%. The maximum tax rate for capital gains and dividends is 20%. So the more money that we can get qualifying for this 15% tax rate, the less taxes that we're going to pay. And while you're in transition, it is a great time to end deferred income. So if you had annuities over the last 10, 20, 30 years, and you've got untaxed gains, rather than Social Security and retirement savings, take money out of that annuity. And again, you can take a lot of money, $80,000, $90,000, $100,000, and pay 10 or 12% tax. Government savings bonds. This is a great time. Deferred compensation. So you want to defer money when you're in a high tax bracket, and you want to end those deferments when you're in a low tax bracket. And your tax bracket is not going to get any lower because you don't have a job, unfortunately. Well, fortunately, you don't have a job. You don't have to take Social Security. You don't have to take money out of your retirement plan. So you just got interest and dividends and maybe some gains coming in. Great time to end those deferred income things. And we want to get that tax bracket strategy so that we can take advantage of that. I had a guy come in and client, and he was very happy. He said, I didn't have to pay any, brought his tax return with him as we asked him. Didn't have to pay any taxes last year. So we're not getting Social Security. We're not old enough to have to be taking money out of our accounts. And we're just living off our savings. No taxes whatsoever. And I said, that's a shame. Let's change that. And he said, why? I don't want to pay any taxes. So we did this tax rate review. And in 3 years, he's not going to have a choice. He's going to be in a 25% tax bracket. So let's go ahead and take some money out at 10 and 12%. So in transition, you have to be proactive sometimes and not just say, whoo, I'm not paying any taxes now. You need to review the purpose of your life insurance. If your death creates a problem that cash solves, you probably ought to keep your life insurance. If your death is an emotional loss, but not an economic loss, then maybe the life insurance is optional, and that's up to you. Sometimes the premiums get so high, people worry about paying them, or sometimes people worry, is the cash value earning enough money for me? Could I make more money someplace else? So that's just a personal preference, but we can look at you and your insurances and the cost. And if your life would be better without having to make payments, or if your life would be better because we could create more income, then let's have that discussion. Before you're age 72, if you don't need the money and you're in a low income situation, again, as I said this earlier, go ahead and take money out to get it up to that 10%, 12% tax bracket. Fill that bucket up. And maybe if you've been in a very high income situation, you might want to fill up to 22% tax bucket. All these taxes are going to go up in 2026. That's when the current tax law ends. Okay. And then during transition, this is a fantastic time to explore Roth conversions. So this is a Money Guide Pro, one of our programs. I had a client that retired. He was 68. And what we did and what this program did was I said, let's calculate how much we can convert from his IRA to his Roth and not exceed the 22% tax bracket. And on the bottom left-hand corner of this chart, you'll see 3 bars that are yellow. Those are 3 years of Roth conversion. That's 68, 69, 70, and 71. Those 3 years of conversions over his lifetime saved him $156,000 in taxes. And the great thing about Roth IRAs or Roth accounts is there's no tax on the interest, there's no tax on the dividends, there's no tax on the growth, there's no tax on the money when you take it out, and there's no tax to your heirs when they receive it. So it's there's 2 ways to put money into Roth IRAs. And one is to be working and have earned income, but be under $200,000, then you can make annual contributions. Or if your retirement plan allows Roth contributions, your 403b, 401k, you can do that. The other way is to take money out of a taxable account and put it in a Roth and pay taxes on it. And that's what we did here. So we volunteered to pay some taxes for 3 years to save a lot of money over the long term. So when we're looking at this, the winner is not the person who pays the least amount of tax this year, but the one who pays the least amount of tax over their lifetime. And that's what we're trying to do in transition. And then we start with accumulation. That's the beginning where we build our foundation. And our bullet points here are for better investment results. And we're not going to concentrate on investment consulting in this talk, but there are 4 things you do need to do. And that's build a globally diversified equity portfolio, capture market returns, take advantage of what's right with the market, not what's wrong. Invest based on academic research or evidence-based investing. And if you'll do those 3 things, then you will accumulate growth and unrealized gains. And accumulation is the prime time to accumulate growth and unrealized gains. And a lot of things you do in accumulation are going to impact you later in life. So we always say save as much as possible, or save as much as you can, as quick as you can. But save in a tax-aware strategy. And there's 3, and we talked about them, 3 tax strategies: tax deferred, that postpone taxes; tax-free, these eliminate taxes; and taxable account, these receive preferential tax treatment. Each of these 3 strategies should be utilized during accumulation. And here are our tax buckets again. So we've got the tax deferred, the pre-tax, where you get a write-off, and you save taxes while you're putting money into your retirement plan. It lowers your current tax liability. When money comes out, it's taxed as ordinary income. We've got tax advantage or taxable. These are brokerage accounts in your name or joint with your spouse, your bank savings accounts, your home, any other real estate. We get preferential tax treatment here on our qualified dividends and capital gains that come from common stock, because we pay a dramatically lower tax on it. And at death, these unrealized gains disappear, and our heirs don't have to pay tax on it. And then the Roth, we buy Roths with what I call milk and bread money. It's money when you go buy milk and bread in the store, you've already paid taxes on it. Money that goes into a Roth account's already been taxed. So, but it does grow tax-free, it comes out tax-free, and it goes to your heirs tax-free. So keep those in mind. So I said decisions you make in the 30s impact you in the 80s, and that's because of asset location. Which one of these buckets, which location did you use for your money? So with asset location, you match ordinary income producing assets with ordinary income accounts. So retirement accounts have ordinary income taxes. So in those, if we're going to match it up, consider buying things that create ordinary income, such as bonds and guaranteed accounts and CDs, things like that. So what we're doing is we're sheltering you from having to pay taxes on interest, basically. Okay. Now, these are all lower growth instruments. And so your account does not, your retirement account does not grow as much. Because it does not grow as much, it lowers the future amount that you have to pay and your required minimum distributions. We think you should have equities in your account. So position equities for preferential tax rate and tax-free step-up. Because these offer higher rates of return, put equities in your taxable brokerage accounts that are in your name or joint with your spouse. And you want your Roth to be part of your high growth engine. We want to optimize asset placement and account structure for future tax-free distribution. So whether it's a Roth IRA, 401k, or 403b, we like to make that part of our high growth engine. We want our taxable account to be part of our high growth engine. Why? Preferential tax treatment. And one, totally tax free in the other. And in the retirement account, we're going to pay ordinary taxes. So why do I want something to grow to be gigantic that I've got to pay ordinary taxes on? So one of the advantages of owning equities is they grow faster than bonds. And we want to position these for what we call tax loss harvesting. When stocks are in a taxable account, Uncle Sam shares the risk with you. When stocks are in a retirement account, you lose the ability to tax loss harvest. So the government is not sharing any of the risk. If the government potentially owns up to 37% of your retirement account, do you want it to be your highest growth engine? Maybe not. Now, if the only way you save is with tax deferred accounts, you have to include stocks for growth and inflation protection. But if you're using all three account strategies, tax sheltered, tax free, and taxable, asset location gives you exactly the same overall growth rate with better after-tax results. So what we see is a lot of people come in and their 401k or their 403b or their IRA are full of stocks, and their personal accounts are all CDs and money markets and checking. Well, we think you'd be better off reversing that process and putting a lot of stocks in your Roth, put a lot of stocks in your personal, and put a lot of these CDs and bonds and slow things in your retirement account. You would pay less in taxes. So don't volunteer to trade low taxes for high taxes. And we see a lot of people that are doing that. And then at the tail end of the accumulation, right before you retire, it's critical to add value to what you're doing. And there are ways we can do that. We'll manage tax bracket creep. We're going to defer income, and we're going to accelerate deductions. So obviously you're late in your career, you're making as much money as you've ever made, probably paying as much in taxes as you've ever made. And so you've creeped that bracket, might have creeped up some. Well, now, if you're not already maxing out your retirement account, that's the time to do it. Put as much money into it as you possibly can. And I even tell people, you might even want to practice living on what you think your income will be, so that when you retire, it's not a total surprise of the life that you're leading. And then we want to accelerate deductions. Well, how do we accelerate deductions? Well, if you are charitably inclined, we can do so with a charitable donor advisor fund. So what happens here is, let's just assume that you're 65 and you're going to retire, and you give the charities, not just the church, but all charities, $10,000 a year. Well, let's accelerate the deduction by bunching up your future contributions. So if you're going to retire at 65, let's take the next 5 years and put $50,000 into a donor advised fund. And what that does is it gets you a big deduction in the year of contribution. So now we've exceeded the standard deduction. So we've got our contribution plus our state income tax plus our property tax. And if there's any mortgage interest, we get that as well. So it lowers our income, it saves us money in taxes. And when we retire, rather than taking $10,000 out of our retirement income every year, we take $10,000 out of our donor advised fund. While the money's in the donor advised fund, it grows and there's no tax on it. You can invest it aggressively or conservatively. It's up to you. So we've bunched up those next 5 years. We get a tax deduction, and we can turbocharge that by gifting assets with unrealized gains, highly appreciated assets. So sort of the cherry on top is, I've got an account worth $50,000 and I only paid $24,000. I can take that and gift it to a donor advised fund that I have control over, and I get a deduction without ever having to pay tax on that $30,000 of appreciation. When it's in a donor advised fund, I can take it all out in 1 year. I can spread it out over 20 years. I can go 3 or 4 years and not take anything out. Or I can do as I plan and take $10,000 out every year for the next 5 years. So why not just say for 5 years? Well, what happens at 70 and a half? That's when we go back to making qualified charitable distributions from our IRA. So we're just trying to fund up until we're eligible to do that. Okay. Savings and investing decisions you make now will impact you for a long, long time. Don't just think about the future in the future. Think about the future now. And we covered a lot of things. And I went as fast as I could, and I did not get to go into as much in depth as I wanted. But the advisors at Elevate can discuss these points with you. So if you have any questions, give us a call, or just thank you for hanging in there with me. We covered a lot. And as I said, we created a 5-page workbook, Strategies for Retirement Transitions. If you want a copy of it, email marketing@elevate-wealth.com, and we'll gladly email you a copy. Okay. Betsy, do we have any questions?
Thank you so much, Chuck. That is wonderful information as always. And one question, just somebody wanted you, could you repeat what you said about the contribution to the IRA? Is it written directly to the IRA, to the charity? Is it written to the recipient? How do they get it to the charity? What's the best way to do that?
When you do a qualified charitable distribution, your IRA custodian writes the check to the charity. Now you can request that they mail it to the charity, or you can request that they mail the check to you. I like for the check to come to you. And the reason is the charity gets a check from Charles Schwab or whoever the custodian is, and it does not say on there who it's from. So they don't know it came from you. So I like having it sent directly to me, and then I get to give it to them. And in this office, that's normally how, when we fill out the paperwork, that's normally how we do it.
Perfect. Okay. And I'm going to go ahead and share my screen real quick with y'all. Let's see if I can get this to work. But I wanted to make sure everybody knew about our new YouTube series that we're doing. It's called WealthWise. And every Thursday we have a new episode. You'll see each of our advisors will do several different episodes focused on a different subject. And so when you go to YouTube, just search for Elevate Wealth Advisory. And you can see on our playlist, you'll see all of our past webinars are there, as well as all of our WealthWise videos. So feel free to go and hit that subscribe button. And then that way, every time we have a new episode, which is every Thursday morning, you'll be able to see that. And then also just wanted to remind everyone to go ahead and follow us on Facebook. That's where you'll get information about any events we have coming up. And then here's our website. You can go to elevate-wealth.com, and you can sign up here to get our monthly newsletter. You can sign up here and go directly to our WealthWise video series right here on any of these links down here. So I just wanted to make sure everybody knew how to connect with us. And again, if you have any follow-up questions from today, just email marketing@elevate-wealth.com. We'll make sure Chuck gets your questions answered, and then we'll also get you a copy of the booklet that he discussed. Thanks so much, Chuck.
Thank you. Thank y'all for tuning in.
Have a wonderful week and a great June.
So long, everybody.
Bye.